bank numbers out, and the numbers look extremely impressive. The net profit is a good 200 crores above market expectation. And the most important number, of course, the NPA number, has come in lower than the previous quarter. At a time when a lot of companies are coughing up more and more NPAs, Axis Bank's total gross NPAs has fallen from 34,000 crores to 32,000 crores, a fall of about 1,600 crores. And as a percentage of total loans, it has fallen from 6.77% to 6.52%, a fall of 25 basis points. As net NPAs, which is a very important number to track because it will give you the provided number, that has fallen from 3.4 to 3.09, which is a fall of 31 basis points. Provisioning has, of course, risen, but that's on a year, for the quarter ended, on a year-on-year basis, the provision has risen, but on a quarter-on basis, the provisioning has actually fallen from 7,000 crores to 3,000 crores.
I'll just highlight, the NII has come in at 5,167 crores. That compares to our poll of 4,890 crores. So it's a top-down beat, whether you look at NII or whether you look at the PAT. The slippages have come in at 4,337 crores. We were working with the slippages anywhere between 5,000 to 5,500 crores. So the quarterly slippage is at 4,337 crores. That compares to about 16,536 crores on a sequential basis. Therefore, you are seeing a decline in gross NPA. That gross NPA in absolute value is down 4.6%, and it has come in at 32,662 crores. Okay. If you look at the gross NPA ratio, that has come off by 25 basis points to 6.52% versus 6.77%.
Okay. Yeah, Abhishek, now the entire table is there because they have put their presentation as well. As you pointed out, the opening NPA figure has dropped from 36,000 to 34,200. In that, the fresh slippages is 4,337. The street was working with an average of 5,000, 5,500. 4,300 is a little, I think it's the least since the first quarter of FY18. After that, they had 8,000 crores, 4,500 crores, and then they had 16,000 crores, quarterly speaking. So it's now 4,300. Upgradations are fairly decent at 2,900, so almost 3,000 crores, and write-offs of 3,000 crores. So that makes the closing gross NPLs to as low as 32,000, a fairly big improvement. Provisions and including interest capitalization is about 17,000 crores, and therefore the provision coverage ratio works out to 69%. Again, more impressive than perhaps ICICI, which has 66%, and as impressive as Bank of Baroda, which also had 69%. That looks like, yeah, go ahead, please.
The net interest margin has come in at 3.46%. For the last 6 to 7 quarters, the NIM or the net interest margin had been on a declining trend, declining from as high as 3.9% to about 3.33%. That has been arrested, and the net interest margin is up 13 basis points quarter on quarter. I'll give you another balance sheet number. The deposits have grown by 13.55% on a YoY basis. So the total deposit is at 4.47 lakh crores, and we were working with a loan growth of 18% plus. However, the loan growth, we were working with 15% plus. The loan growth is a tad bit shy at 14.4% YoY. So it has come in at 4.41 lakh crore. These numbers on the outlook, at the outset, look very good in terms of their, arrest of net interest margin, slippages coming lower, and your asset quality improvement.
Okay, I'll just come to the net interest margin in just a minute. The credit cost, which is, your provisioning as a percentage of the total loans, that has fallen to 2.45%. It was very high at 6.7%, 6.73 to be precise, in the fourth quarter. So 2.45 almost brings it to the average of FY18, not counting the fourth quarter, which was, of course, very high. The NIMs again, I just that
3.46%, and that compares to 3.33 on a sequential quarter.
So it's an improvement.
It's an improvement right from Q4 FY16 when the NIM was at 4% till Q4 FY18. That is for 8 to 9 quarters in a row. The NIM was on a declining trend. So that has been arrested, and that is a very good point to see that your net interest margins have now got arrested, at least for this quarter.
Abhishek, we'll first give the numbers and then get the editorial in. They have also, since the entire presentation is there, we can inform you of more numbers. the concentration to stressed sectors has declined from 5.2 year ago same quarter to 2.4%. Last quarter it was 2.5. So even quarter on quarter it appears to have declined, though I think only for iron and steel it has gone up a bit. So, well, basically speaking, it looks like it's a fairly good improvement. 78% corporate exposure is to companies rated A or better. 78%, that's another figure that the company has given. And a steady growth in fee income as well. But I'll ignore the numbers for the moment and go to our guest. Krishnan ASV, the lead analyst at SBI Cap Securities, joins us. Krishnan, of all the numbers we read out the stressed assets to you. They have declined. The gross NPAs, the fresh stressed assets is or fresh slippages is 4,300 crores, and the profit is 701 crores. Your first thoughts?
Yeah, hi. So again, I mean, from the looks of it, seems like an impressive set of numbers. A tad lower on the earnings compared to where we were penciling in, but then that could be explained because they are shoring up the balance sheet just like ICICI Bank.
What fell short?
The PAT. So we were at close to about 800 crores from a PAT forecast. To that extent, I mean, as I said earlier this morning to your guests, to your viewers as well, we are not looking at, a bottom line per se. What we are looking at is more trends around balance sheet improvement, and that has been fairly impressive. So,
yeah, 69% provision coverage ratio and fresh slippages. What would your thoughts be on asset quality?
Yeah, I mean, broadly, we have been expecting this, Lata. I don't think it's coming as a surprise to us. I think we've been saying anywhere between 440 to 50 billion, so 4,000 to 5,000 crores of slippages is where it will normalize for at least a couple of quarters now.
Okay.
But of course, the headwinds remain on the power sector, etc., and Axis is more exposed or vulnerable to that sector compared to, say, an ICICI Bank. So that remains a bit of a headwind. But having said that, earlier today morning, we remain constructive on these corporate lenders. I think we have maybe one more quarter of pain in terms of asset quality to go through. But from an earnings perspective, I think that's what we will look forward to. We are looking for where the earnings catalysts are beginning to turn around.
Any more details you want to add, Abhishek?
See, the lower rated book, the double B and lower rated book, that has increased sharply quarter on quarter. So that double B rated book is now at 10,396 crores, and this is only the funded part that I am talking about. I am not talking about the non-funded part. The double B rated book is now at 10,396 crore versus 8,994 crore. So that's an uptick of 15.6% quarter on quarter. And if you look at the non-funded part of double B rated, that was a 2,400 crore in the previous quarter. I don't have the number for the current quarter, but in the previous quarter, the double B and lower rated profile book was at 2,400 crores.
They have given it in percentage terms on page 43 of the presentation, and that in percentage terms says that the double B or below has fallen from 10% to 6%, but this is a year-on-year comparison. And triple B has fallen from 22% to 16%. They have actually said that 78% of the corporate exposure is A or better. That's the number that they have given. You want to check but that is only in percentage.
Lata, this is the entire portfolio's rating. This is not the stress portfolio rating.
Fine.
So the stress portfolio, which is under stress or under watch list, and that is, that has increased 15.6% on a quarter-on-quarter basis. Sri Shankar, the head of institutional equities at Prabhudas Lilladher, joins us. How do you view the results, sir?
Yeah, it's reasonably better, and it probably brings to the fact that you are reaching towards the bottom end of the cycle in terms of NPAs. And if you actually look at it, even more than 80% of the slippages have actually come from double B and below, which is, I think, more or less in the expected lines.
Okay. Is this okay? We've got the management the management will start speaking anytime now. So quickly, okay. There's I think Shikha going to speak. Okay, Sri Shankar, would you call a buy on the stock now after looking at the numbers?
And let's hear the management also what they speak about it in terms of it. I think if it is going to be the trough what we are seeing, it's going to be something quite interesting right now.
Okay, Krishnan, we can still have one more word from you before Shikha Sharma starts speaking. A buy on the stock?
We have a buy recommendation. That's our preferred play on corporate lenders. Yeah.
Okay. All right. Ashutosh is joining us. He's the senior research analyst at Reliance. Ashutosh, Reliance Securities. Ashutosh, how any thoughts on the numbers?
So the best part is that even from this year's slippages, roughly 88% has come from the BB and below rated books. So the slippages is mainly coming out from the stress book, which they have already identified. So overall numbers are quite good, and they have shown improvement on all major fronts.
All right. Okay. Ashutosh, so you have a buy or a sell or a hold on the stock?
We have a buy rating on the stock at this point of time.
All right. Thank you very much, Ashutosh, for joining us. I think the management is ready to speak anytime now. And the key takeaways from the results are profit is higher than what the street expected. It's come in at 701 crore. But most importantly, asset quality appears to have troughed out. We've seen some very good numbers. The actual overall gross NPA has fallen from 34,000 crores to 32,000 crores, 30,600 odd crores, a 1,600 crore fall. And more importantly, as a percentage of total loans, it's fallen from 6.77 to 6.52. Fresh slippages, fresh NPAs that the bank has generated has fallen to 4,300 crores. It was 16,000 crores last quarter. And an average of the previous quarters also, it was on an average higher than 4,300. So it looks like they have belched out most of the bad loans, and maybe things will heal from now, but we really have to wait for the management to tell us that. Net interest margins have also moved up after a long bout of falling. They've moved up by 10 basis points, Abhishek?
They have moved up by 13 basis points to be precise, and that's a heartening part. You know, two key takeaways that I take from the results is that slippages of non-watch list are getting arrested, while your net interest margin is now on an improvement trend. Sustenance is the key. If they sustain this net interest margin and show an improvement going ahead or sustain it at this level, then it will be positive.
Okay. There is, of course, another asset quality review coming. There are power assets which this bank is exposed to. So a lot depends on how power policy also of the government works. It's a long wait. I don't know what they're waiting for. The management seems ready. They've taken up their seat. Well, maybe you want to give us a little more on advances growth, 14% advances.
Welcome,
okay, that's Shikha Sharma.
Being here for our quarterly results. Before we go into the actual numbers of the quarter, I'd like to just touch on three broad themes. The first is